Let's head to our next management, APL Apollo Tubes. One of those big outperformers if you look at it in the last 10 years or so. Unfortunately, the last 1 to 2 years hasn't been so great from a stock price perspective as well as a business perspective. The last quarter was a weak one, but what's the way ahead? Mr. Deepak Goyal, the Director and Group CFO of the company, joins us on the show. Hi, Mr. Goyal. Good morning. Thanks a lot for joining us here on CNBC-TV18. Now, the question is, have things recovered? You know, infra as a percentage of your total mix is roughly around 25%. The first half of the year, spending was impacted. Are you seeing signs that there is spending coming in from the government on ground? Point number one. And also, you know, just to tie in with that, what is the volume growth you are working with for this year itself?
Yeah, it's the ground reality is there, sir. In the first half, is impacted by the general elections and monsoon seasons. In second half, we are seeing the demand is upcoming and restocking level is again we are seeing at the channel partners levels. So in the second half, we are expecting 10% growth quarter on quarters. First half is impacted due to some regions and our margins are also impacted due to the steep downfall in the HRC prices. So in the second half will be the better.
So for the year, then what should the growth look like? Last year, you did around 2.6 million tons. For this year, you lent at what? 3.2, 3.3?
Yeah, 3.2, 3.3 we are expecting, sir.
For this year. And on that base, if demand is going to come back, what kind of a growth can you look at FY26?
Around 25% growth we are looking, sir. So FY26 we are targeting 4 million tons and for FY27 we are targeting 5 million tons, sir.
Let's not go as far as FY27, but for the time being, at least we'll hold you at this 3.2, 3.3 as well as 4 million tons. The other aspect, you know, which drives the stock is the EBITDA per ton. And that's come down, but you'll have mentioned a couple of reasons. One is inventory loss, second is discounts. So could you tell us what is the outlook? Should we expect some inventory loss even in quarter 3 or that's done? Point number one.
No,
and I will still pushing through any discounts because volumes look good in the past quarter. The problem was on the EBITDA per ton. Go ahead, sir.
Yes, sir. So inventory loss is not in the Q3. We are expecting now the HRC prices are stable and in the increasing trend. So we are expecting no inventory loss is the further. And secondly, sales discounts are giving to capture the market shares that will be theirs but if we our volumes increase, our efficiency is increased, our operational cost is reduced by some amount. So we are targeting EBITDA margins in the normal range of 4 to 5,000 rupees in the upcoming quarters.
In the second half of the year itself, we'll see 4 to 5,000 rupees?
Second half of the year.
One factor with regard to this, you know, grabbing the market share, which you have done, you know, you'll have relatively done pretty okay and volumes are speaking for itself. But when you're going to, you know, pull some market share, in the general part of the business, which some of your competitors are there, that difference between Patra as well as, you know, primary and secondary steel, that has narrowed. So that's where you all will gain market share. But could it be margin dilutive or do you believe give and take everything, still you'll do 4 to 5,000 rupees?
Yeah, our operational margins still, it's are okay, sir. It's in the range of 4 to 5,000 rupees per tons. If gap between the Patra and HRC pipe is narrow, so we gain the market share, sir. And our operational efficiency is also increased. That's why our fixed cost is reduced, our semi-variable cost is decreased. And our margins will improve if our volumes are increased, sir, in the stable market scenario. Only is the one factor is the HRC prices. It's very good for us. In the last quarters, HRC prices are reduced by 7,500. It's very good for us, sir. Because of this, we gain the market shares, we increase our efficiencies, we increase our volumes, and for the long terms, our working capital is reduced. So all the factors, it's very good for us, sir.
I think for you all, the best case scenario is HRC prices are more or less constant as well, you know, instead of fluctuating too much. Now that they've come down and they've narrowed the gap with Patra, I think that will be the best case scenario. We'll have to see how that goes. Suddenly there is some murmur that it could be some duty that will come on imported, imported steel. So we'll have to keep an eye out on that front. Now, besides the operational performance, I want to ask you a couple of other factors, Mr. Goyal. You know, the promoter entity stake has come down. Now it's sub 30%. And from a stock market perspective, the promoter is normally the best analyst, right, on his own stock. Do you think the promoter entity would want to increase stake? Actually, it's come down over the last few years. from around this 28.5%. Is there any inclination? And worse still, do they want to sell some more stake or they're happy now at around this 28% mark? We'll get the chart up for you on the screen.
They are happy at the state present level. In further, no reductions will be there, sir. If they have the funds, they definitely increase their holdings, sir.
Okay. As of now, it is 28.32%, and you're saying they don't want to sell stakes, so we got that. What about their investment in Shankara Building? You know, that business as well is going to go through a corporate action with regard to splitting the business. They have some stake. Is there an intention to either, book out of this stake that they have or add some stakes since that stock price as well has come down?
No, it's a strategic investment, sir. So Shankara Building is our largest distributors and doing the best performance in the couple of years, sir. When we have invested in the Shankara, their volume is around 10,000 per month. Now it's reached at the 30,000, 35,000 per month. So very good volume growth from the Shankara we are seeing, sir. And it's a good paymasters and they are gaining market shares. So we are not seeing any up and down in the Shankara, sir. See, we keep the investment intact.
Okay, all right. Very quickly, you have a small debt in the books of 300 crores. Part of that could be inventory. Part of that could be because of the capex that you all have undertaken as you all go towards that 5 million ton mark. By when will you become debt free yet again?
In next 1 or 2 quarters, sir. It's a very small, it's a working capital only.
Yeah.
So we can see the net cash in the next quarter or next to next quarter.
Okay, but if you're so confident about business and you're going to be debt free, why don't you do a buyback? Some of your shareholders are wondering what happened to that glorious story. The stock price went up and after that it's not done anything. Do you think you could do some buyback or something?
Our management agenda is first, we finish out the total outstanding liability, then we will think about the buyback, sir.
Okay, so is that a possibility that you do a buyback?
First, we finish out the total outstanding liability, then we will think about it, sir.
We'll try to push you on that. Mr. Goyal, thanks a lot for joining in and giving us all those details here on CNBC TV18. You're guiding for better times. First half of the year has been a weak one, so we'll track you to all of these numbers.